So on March 10th, Silicon Valley Bank ended up collapsing and going insolvent. Now on January 26th, the CEO sold about 12,000 shares that he held, or he announced that he would, and he made the transaction on February 27th. He announced this early because he didn't want to get hit with insider trading violations, of course. But the fact that he did this so early before this crash ended up happening and had the transaction to happen at that time, right, days, weeks before it actually happened, raises some questions. And as you can see, he sold the shares for $287 per share roughly, and he then bought the same amount of shares for the lower price that the shares were currently at, which was $105, giving him a profit of about $2.3 million. Now, I'm no genius, but it sounds like somebody was getting prepared for something. Not to mention the fact that his CFO also ended up doing a similar transaction, selling shares and getting about $575,000 from that. Now, while that sounds incredibly shady, which it does, how did this end up happening to the bank, and how does this affect you and everybody else going forward with this happening? Should you be scared of the other banks collapsing and the economy possibly going worse over the next few weeks? We're going to talk about that in just a second. If you're new to the channel, I'm Will Frazier, and I provide information on this channel about personal credit and business funding. And if you like to hear information like that, subscribe to the channel and turn on notifications so you'll be notified of any new videos I let out just like this one. And don't forget to give the video a thumbs up if you end up enjoying the video. Now, before I proceed to let you know what I see that's happening and how this is going to affect you, let me know what you've heard or what you think is going to happen in the next few weeks or months with the current economy that we're in and everything happening with banks failing as quickly as this one did. Now, before I start telling you about how this is going to affect you, you need to know how banks work so that you can understand what happened to Silicon Valley Bank. So basically, anytime you go to the bank, you're going to give the bank your money, in the form of deposits, and the bank is going to hold on to that money. Now, most people think that the bank is just holding on to your money and just keeping it within their system. But honestly, more than 80-90% of the money that you put into the bank is actually being invested by that actual bank. And they're investing it in ways that can bring in some steady cash flow or income to the bank outside of the fees and everything that they charge you for, like overdrafts and stuff like that, interest on loans, stuff like that. So they invest the money that you put in, the majority of it, so the bank really does not have the majority of your money on hand because they have tied it up into investments. What the bank hopes is that outside of you, all of the other people that are depositing money into the bank, they're hoping that they get enough people to deposit money so that they can have enough cash on hand so that they can pay you out money if you come requesting some money from the bank. Now, again, with all these other people, they're taking the majority of those people's money and investing it so that they can get those returns that they want to have coming in. And they don't just invest this money, they also lend this money out to other people, other businesses as well. Now, Silicon Valley Bank had a much different strategy than most normal banks, even though it was pretty much the same. Basically, they weren't like a traditional bank that just had regular consumers coming in as their customers. They catered to the big tech companies, really new startup tech companies that did not have a proven track record, that did not have money coming in, and a lot of them, like I said, they were new ideas just getting off the ground. And I used to work at Wells Fargo, and at that time that I worked there as a business advocate, helping people come in to get business loans and whatnot, and working with the people that dealt with the bigger business loans, they really were not a fan of giving out money to people who did not have money coming in already, strong credit history. On a smaller end, and on a bigger end, you definitely have to have more going on, collateral, something like that, for them to want to feel comfortable giving you money. And there are different levels of banks. There are big banks, which usually have the tightest requirements. There are, medium-sized banks and smaller banks, which are in your regional area. So the bigger bank that I worked at, they were really tight as far as what they needed to give you funds. So this bank, Silicon Valley Bank, giving out money to all of these new businesses is something that I'm not familiar with a bank doing, and most of the big banks don't do it because it's kind of risky business. Now, of course, you can see the idea of why they might do that, because these big tech companies, they have the forecast for making a lot of money. They have a history of making a lot of money, so it seems like it's not that bad of an investment. So with this strategy in mind, they were giving out a lot of money to these startup companies, these startup tech companies, which also burn a lot of money in the beginning stages before they start actually bringing in a lot of money. And they were giving out money at the time where interest rates were extremely low during the pandemic. So they were giving out a lot of money during that time, and they were getting a lot of customers coming in, of course, because they were giving out a lot of money, and those customers were getting funds for their businesses that they needed in the millions and millions of dollars. And of course, because they were getting money from the bank, they were putting that money back in the bank in the form of deposits. And as I already mentioned to you, what the banks do when they get the deposits is they invest that money. Now, Silicon Valley Bank was actually investing their money into government-backed bonds, and they took a large portion of the money that they received, the deposits, and invested that into those stocks that had lower rates, which were, the bonds were worth a larger amount, and they had lower rates. And of course, as rates increase, the value of those bonds decreases, but I'll get to that in a second. Now, one of the problems with their investment strategy was that they invested so much of their assets into this one particular asset or investment, and they didn't diversify like most of the bigger banks do. So because they had pretty much all of their eggs in one basket, that's pretty much their main source of what they were relying on in order to have money coming in and to have their assets and capital locked in. Now, as the Fed kept increasing these interest rates over time, as you've been hearing, that of course made the value of the bonds that they had start to shrink, and that also lowered the amount of capital or assets that they had on hand. Not to mention the fact that interest rates were rising. That means that funding was also starting to lock up, as you might have seen. If you're in business, you might see this more, and as a person, you might kind of see it. Banks weren't giving out as much money in this current time. So that means these companies, which relied on a lot of funding to get started and to keep operations going, they weren't able to get access to capital, and interest rates higher and all of that stuff. So they ended up having to use a lot of their deposits in Silicon Valley Bank, which meant that not only did the cash on hand that they had start to decrease, but also the assets that they had were decreasing in value. Now, because Silicon Valley Bank wasn't getting a lot of deposits in the door because they did not have the companies that they cater to getting more funding, that means that they ended up having to do something in order to take action to try to get some money. So what they did with the higher interest rates and the lower value of the bonds that they had paid more for, they ended up trying to sell those bonds. They did sell those bonds, and then they sold them at a loss. And they already had people dipping into their deposits more, and the announcement of them needing about $2 billion in funds didn't sit well with a lot of people. And then that of course triggered the people that were customers at the bank to go in to try to get their money out of the bank, because it looked like they were not about to have money to cover people's funds. Now, this led to the bank collapsing in under 48 hours once the word got out and everybody started making bank runs trying to get all of their money out of the bank. So now, of course, you might be thinking, what about FDIC? They're supposed to insure up to $250,000. So let's talk about that. So yes, the FDIC does insure up to $250,000. The problem with this situation is, as you can see here, the Silicon Valley Bank, 97% of their clients that they had more money than $250,000. Most of them had money in the billions in regards to how much they had in the bank. The millions and the billions. So that means that most of the people who banked there had more money than that, and they will not be covered up beyond the $250,000, which is a big problem for a lot of these tech companies that had their money there. And now, what companies actually lost money there? What tech companies is it? And will this affect people? Yes, it will. So let's see which companies exactly have been affected, or some of them at least. You can see here Roblox. You might have children that deal with Roblox or use Roblox. They had about 5% of its assets over there at SVB. So that was $150 million. So of course that's not all of them, but $150 million is a lot of money. Roku, which a lot of you use, they had about almost $500 million, which is 26% of its cash and cash equivalents, it says here. That's more than a quarter of all of their money tied up into this loss that is happening there. And we're going to talk about people getting their money back outside of that in just a second. BuzzFeed, very popular digital media firm. A lot of people know about BuzzFeed, and 15 million in cash and equivalents, 56 million, was tied up in this. Let's see who else we have here. There's also Rocket Lab, Circle, BlockFi, Payoneer, which is a platform that some people use to actually pay employees. They had about 6.4 billion in cash assets, and 20 million was at SVB. So there are a lot of companies here that you can see on this list that actually had money at that bank. So a lot of places ended up losing money because of this. Now, what are some of the repercussions that are going to happen because of this? Well, one thing that might happen is regional banks might actually be affected by this. Why? Because a lot of people are going to hear about the Silicon Valley Bank failing, and then they're going to go and try to withdraw all of their money out of their local banks that they bank with. And of course, that anytime there are bank runs and too many people start taking their money out of banks, the same thing is going to happen to those banks. And it never, of course, works out for the good of the economy. So that can make things worse in that light. Now, also, you have to think about it. These companies that are losing money, a lot of them that I mentioned, they have, millions of dollars, and they didn't tie up all of their money, but there are some smaller tech companies. So a lot of those smaller tech companies that did have more of their assets tied up into the bank, they're going to lose a lot of that outside of the $250,000, of course. And if they have a really decent sized company and a lot of them pay high payroll, they have high salaries that they pay out, and they have a lot of people on payroll, so that means that they're not going to have the money to make payroll. So that's people who are essentially not going to be able to pay some of their bills, not going to be able to pay their rent, their mortgage, their car note, because now the company that they work for does not have the money to meet payroll. And God forbid the whole company has to get shut down because of this. Not to mention there are some people that work at Silicon Valley Bank who also have bills to pay, and it's kind of uncertain about what's about to happen in regards to the bank. Is it going to be sold off in pieces to other banks? Will some of the larger banks want to take on these assets and this money owed and everything like that, which the larger banks might not want to do it, even though they're the ones that can afford it, because they would also be taking on riskier clientele, being those tech companies that don't have a lot of history, and they didn't have a whole lot of money coming in, and they are usually in the red in the beginning until they start becoming profitable. So the bigger banks might not want to take on those types of clients. So that's things that we have to look at and how that's going to affect this. And as far as the FDIC insurance, of course, most of these companies are going to be able to get their $250,000. The problem lies in beyond that $250,000. That can actually take years to get the difference in money that they had in the bank versus that $250,000 that is guaranteed to them. So, this is something that can really affect a lot of people that is happening right now. And of course, it can affect the economy, because a lot of these companies that lost money in the bank also saw dips in their stock prices because of this loss that they took. Because again, these companies had millions of dollars in the bank, and to take a loss like that means that it's going to significantly affect what you're able to do and how you're able to operate. And of course, with several people being unable to pay their mortgages, being unable to pay their rents, possible foreclosures, possible repossessions because of that, all of these are things that could affect it. It might not get to a large scale, and as far as a bunch of other banks just immediately collapsing, it's not necessarily a guaranteed thing to happen, because this bank, Silicon Valley Bank, had a unique way of investing their money and a unique clientele that they service. So most banks aren't like that, so it's not a guaranteed even though some of the other effects of the economy that are happening can eventually make things a little bit harder and affect everything with these other banks too. So ultimately, we won't really know the full effects right now at this moment, but you definitely need to keep your eye on everything to see what is happening and how it unfolds. But if there's anything that you can learn from this, is to always not be scared to invest your money, of course, because the banks take your money and invest it themselves. But when you invest, even on a large scale or small scale, you want to make sure that you are diversifying any money that you invest. Now, should you pull all of your money out the bank and just put it under your mattress? I would say that it's not always going to be a good thing to do that. Of course, you want to have some cash on hand, but you also can't have thousands of dollars just sitting around your house either. That's not a good idea either. But basically, you want to make sure that you're doing more, what I would say, investing of your money versus just letting your money sit in the bank account where you're barely getting any interest anyway, and they're going to charge you way more for a loan, anyway, compared to what you would get with flipping your own money and being your own lender, being your own bank, and all of that good stuff. So I would say definitely you do want to keep an eye on what's happening. Definitely do invest your money more than have your money just sitting in the bank. And those are the best takeaways that I can give you on this topic. So thank you guys for sticking around for the video. Hopefully you enjoyed it. If you did, give it a thumbs up, subscribe to the channel, and I'll see you in the next video.